It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show, and we've got an exciting day today. We've got lots of great stuff we're going to be covering, and I just want to touch real quick. The last couple of weeks, we have covered the first two sections of a three-part series that I call The Enemies to Cash Flow. And, of course, the first one I talked about a couple of weeks ago was basically taking control of your money, having control, access to your money. Very important. Also, we talked about consumer debt versus strategic debt. Obviously, you want to get rid of consumer debt as quickly as possible, especially high-interest consumer debt. Strategic debt, of course, is debt where you can create wealth by using other people's money, if you will. And so you can build wealth with strategic debt, and so it's not a bad thing, or sometimes known as good debt. I bring that up all the time because I get asked constantly. I've been doing this 22 years working in the financial arena, and as many people know, I'm also an entrepreneur. Really, I've actually owned 5 companies, started 4. The most recent one I'm working on, I'm chairman of the board of a local community bank in formation. So I've owned a retail business. I've owned a service company. I've owned a financial company now, of course, for the last 15 years. And so you learn a lot of things as a business owner, and that's why access to capital, as I point out, is one of the key things of success for any business. In fact, that access to capital is so key. Information from the Small Business Administration and such will tell you repeatedly that the 2 major reasons why businesses fail, and we all know the statistics and we've heard them, the vast majority of small businesses fail in the first 5 years. And the 2 major reasons, according to the Small Business Administration, is this: lack of knowledge and lack of capital. And one or the other, or both, is what causes those businesses to fail in most cases. But again, as I'm digressing here, but that's so important to understand, and that's why your personal bank is so important, because you got to think like a banker versus an investor. You have to have access to capital for opportunities when they come across and for expenses or emergencies when they happen. That is a key financial success secret, if you will. It eliminates stress when you have the funds to cover those unexpected expenses that happen in our lives to all of us. It's just one of those things that happen. So, again, access to capital, minimizing consumer debt, using strategic debt strategically, obviously, to build wealth when appropriate. Of course, creating tax-favored income. We talked about that last week, and that's a tough subject. Kind of boring. Taxes is never fun to discuss, but it's one of those things that has to be discussed because, well, it impacts all of us. And the reality is the key point about tax-favored income is retirement accounts, particularly your qualified plans, your IRAs, 401ks, TSAs, and whatnot. You defer most of those accounts. You defer the taxes on a small amount of money today, the seed as we call it, to then pay taxes later in retirement or the harvest. And the question you have to ask is it worth it? Is it the right way to go? Overwhelmingly, it seems these days, we're advised and recommended to put money into IRAs, 401ks, and whatnot. And, of course, if you've got a company match, by all means, I'm in complete agreement. Always take free money whenever somebody's going to give it to you, right? That's a no-brainer. But I see people maximize 401ks and add more even, and what they're doing is deferring taxes or kicking the can down the road. Does that make sense? Maybe. Most people don't really take a look and really analyze it and to see if it makes sense. And what I mean by that is this, 2 things. Again, I already stated, does it make sense to pay tax on the seed, the small part, the contribution, or on the harvest? Typically in retirement, hopefully on a much larger pile of money, if you will. Obviously, if you got a bigger pile, you're probably going to pay more overall in taxes. Secondly, what are the tax rates going to be down the road? Nobody knows. Can you predict the political situation of where taxes will be in the future? I know I can't. I don't think anyone can. And the facts are we're in one of the lowest, in fact, the 3rd lowest tax bracket environment in income tax history. So if you think about it, if you're deferring taxes today in a low interest rate environment to then have to pay them later, hopefully on a much larger amount, certainly into an unknown tax rate environment, certainly could be higher. Does that make sense? Those are things you have to think about. The third thing I want to talk about, though, that's a cash flow enemy for most people is they fail to really understand or tap into the power of compound interest. Now, before I touch on that, I just want you to know that, if you want more information on these things, like the taxes that we discussed, consumer debt versus strategic debt, having access to your money, control of your money, if you will, contact us at yourpersonalbank.com or toll free 866-515-6280. I'll be happy to talk to you about your situation and see if this is a good fit. It's not for everyone. I understand that. But I will say this, if you've not looked into it, do yourself the favor and do so. Also, if you've considered using one of these tools, look at it again. Tools, and I should say this, I've said this often too, financial tools, one of my pet peeves. Tools are agnostic. Tools are tools. They're built to do a job, whether it's a financial tool or it's a carpenter's tool. A hammer is designed to drive nails. A saw is designed to cut wood. A hammer's not very good at cutting wood, and a saw is not very good at hammering nails, yet you can do those things. And the other analogy I've used, I think people enjoy, is you can have a sports car, you can have a pickup truck. They're both modes of transportation. They're both vehicles that'll get you from point A to point B. One, certainly, the sports car has capability of getting you there much faster than the pickup. But the pickup can carry a lot more stuff. The question is, what's your goal or what's your purpose on this trip? Is it to get there as quickly as possible? Or are you trying to haul a bunch of stuff because you're moving, for example? Sports car is not very efficient at moving, is it? So, again, what's important is the tool bad. All the tools have a specific purpose they're designed for. What I see frequently in my 22-plus years of experience working with clients is I often find bad fits. In other words, round pegs and square holes. I get that all the time. That's why we talk to people and we ask a lot of questions and we listen. And my goal is to find out, what is your purpose? What's your purpose on this trip? Are you trying to get there as quickly as possible, or are you needing to bring a lot of stuff, for example? Are you trying to drive a nail, or are you trying to cut wood? Everyone's different. Everyone's goals are different. Everybody wants to accomplish things that are different, and their situation is different. So one tool is not the right fit for every person, and that's why even in the personal bank concept, there's 3 different options that we can go with just in that. We're a fixed index or leverage option. And again, contact us for more information on more details on any of the 3 options and see again if it's a good fit for you. Some you have to qualify for, therefore not a good fit. But my point is it's worth looking into. And the reason I said if you have looked into this, and by the way, when I speak to different groups, and I'll have 100 investors in the room or whatnot, and I've been doing this for now 4 or 5 years, speaking to different groups around the country, primarily investor groups. And I'll ask how many people are familiar with this concept, the personal bank concept and that type of thing. And invariably, I'll get 2 or 3 hands will go up in a room of 100. And these are investors. These are people that are focused on money. So again, this is not something most people have looked at. Or if they have, I want you to understand something else. Things change. Products improve. There's a lot of new products involved. In fact, this past 2 years, I was involved on the advisory board of a major company helping create two brand new annuity products, which, in my opinion, are the best ones in the market today. If you want to know what those are, contact us at yourpersonalbank.com. But things are constantly improving and changing. So if you looked at it 2, 3, 4, 5 years ago, I can tell you there's better options today, probably with more cash available, for example, today. So, again, we're going to cover a lot of great stuff today, and we have an awesome guest coming next week. It's going to be a surprise. Stay tuned for next segment where I'm going to really get into the power of compound interest. This is Ference at the Your Personal Bank Show. Contact us, 866-515-6280 or yourpersonalbank.com.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. We're having some fun covering a lot of great stuff, talking about your money and how your personal bank can impact that in a significant way. Again, we just touched on strategic debt versus consumer debt. We talked about creating tax-favored income. Now let's talk about the third and probably the most powerful key financial tool concept you need to understand. It's something that most people, frankly, don't get or don't fully understand and don't take advantage of. And what is that? It's tapping into the power of compound interest. You know, it's been referred to by many people as the eighth wonder of the world, for example. Compound interest is powerful. But one of the things you need to understand about compound interest is this. It takes time. And one of the biggest challenges that American investors have, and this is from the Dalbar study, which is an independent statistical research study. It's been done over 30 years now, and I read those studies every year, as most financial folks do. And I notice something that is in there repeatedly year after year after year. And one of the biggest mistakes, according to Dalbar, that investors make is this: too short of time horizon. In other words, in the Dalbar study, they state that the average investor focuses on 3 to 5 year timelines. Why is that? Why do you think they're focusing on that 3 to 5 years? Well, frankly, I believe, this is my opinion, but I believe a lot of it is we're preconditioned to do that. And everyone around us is focused on that time frame. What do I mean by that? Well, certainly a mutual fund manager or a fund manager of any sort is focused on the performance of their fund they're managing over the next few years. Because if they don't do well, if they're not successful in the next 2, 3, 4, 5 years, let's be real, do you think they're going to have a job? So obviously they're focused on short-term results to keep their job. The advisor, nothing against the advisor, but again, if you're working with an advisor and there are not positive results in the next, say, 1, 2, 3, 4, 5 years, what's the likelihood of them keeping their job? Or are you going to find someone else? So again, their focus is in the shorter term in terms of getting results, which is not a bad thing. Please understand. But just because that's their focus doesn't mean necessarily that should be yours. Why do I say that? It's quite simple. When it comes to income, we invest our money to grow for us, to work for us over time, and ultimately to supplement our retirement. I mean, that's the most common focus that people have on investing, okay? And the question I ask all the time I love doing this in front of a group of people when I'm doing a workshop or whatever, I'll say, hey, how many people have a need for income in the next 3 to 5 years? And there's certainly some people in the room that do. And some of you that are listening have need for income today. And that's fine. But other people, a lot of folks, let's face it, still have a job, business, whatever, some sort of income that's paying their bills and whatnot right now. So they don't really need their investment money, their investments, to work for them in terms of creating income right now. They're growing it for the future. Now, as we go time-wise, as we go forward, I say, how many people need money in 5 years from now? Income. How about 10, 15, 20? Some people 30, 40, even 50 years from now. Your need for income, your money to work for you, is greater in most cases down the road than it is even currently. Unless you're already retired, of course. Then that makes sense. But again, if you're not, if you have an income source now, job, business, whatever, then your income needs aren't as great now as they are in the future, are they? Because at some point when you stop working that job or retire from that business, that income goes away, reduces or goes away, right? So your money needs to take over. So my point is, having the short term is important. I tell people this all the time. Next 3 to 5 years is important. Of course it is. But for many people with their money, the next 10, 20, 30 years is vastly more important. And this is why compound interest is such an important concept and come into play. See, the key to understanding compound interest is understanding the difference, the difference of compound interest versus average rate of return. Okay, what's the difference? Because, see, most people are focused on average rate of return. For example, if you get a statement, an annual statement, mutual fund, brokerage account, or any type of statement, it's going to show you average rate of return. Anything market related is focused on average rate of return. And again, what do I mean by that? Now, again, I have a challenge here because this is radio. And with radio, I can't show a visual. So if you want to contact us, and I can send you this visual to help you understand this, the average rate of return versus compound interest, be happy to do so. And contact us at yourpersonalbank.com, and we'll send this to you. It's a simple little piece that really shows the difference, or 866-515-6280. But I'm going to try to describe it to you. And if you take a minute here and visualize two lines. One line is, I'm going to call it the red line. And the red line, and we're going to put this in a 10-year period. In this 10-year period, the red line is going to go up. And one of those years, we're going to have a 20% loss. So we're going to go, and then it goes up again. Now, if it's an average rate of return of 8%, for example, it's a common number I see out there that people use. Assuming your average rate of return, you had a mutual fund statement or whatnot, a brokerage account statement, whatever, and it said you received 8% average rate of return over the last decade, last 10 years. It went up every year except one. 9 of the 10 years, it made more than 8%. 1 year, it lost 20. And by the way, it wouldn't matter which year it is. At the beginning, middle, end, doesn't matter. The math is the math. So remember, it went up more than 8% every year. Went down 1 year of the 10, 20. Now, why do I use 20%? Wall Street defines a market correction as 20%. Certainly, markets correct, whether it's the stock market, real estate market, or any other market for that matter. So we have a correction of 20% 1 year. Your statement would say at 8% average rate of return, because if you added up the 9 years, more than 8, each of those 9 was more than 8, subtracted the 1 year that lost 20, you divide that by 10 years, you would show an 8% average rate of return. Now, here's the thing. I want to think of a second line, a green line. It's a compound interest line. And we're going to use a 5% compound interest, which means every year it goes up 5%. And then it's compounding. The 5% goes up more on top of the 5 every year. Well, here's what's interesting. Again, this is math. I've had people argue with me about this, but the facts are math is math. Numbers are numbers. A 5% compound interest line over a decade, 10 years, outperforms an 8% average rate of return if you've had one 20% loss in any one of those years in that 10-year period. Again, doesn't matter. Beginning, end, middle, whatever. It's math. So my point I tell people is this all the time. You may have a statement that says 8% average rate of return, yet a 5% CD, for example, would have more money in it at the end of 10 years. So the question you have to ask yourself is this: are you really making 8%? The statement says so. You feel good because you've got a statement showing 8% rate of return, but are you really earning 8% when a 5% CD would have had more money in it? Again, this is the understanding the difference of average rate of return versus compound interest. Compounding is powerful. And by the way, the last piece of compounding I really want to share on this is I'm using a 10-year example. And we talked about earlier where in most people, are you going to need money in 10 years from now? Are your needs for income greater 10 years from now than they are today? Many people, I find that's to be true because they currently have income now through job or business or whatever. My point is, what if I took this chart out, these two lines, this red line and green line, out longer, 15 or 20 years? what do you think compound interest line would do over that time? Well, here's the thing to think about. Compound interest increases at an increasing rate. So in other words, that green line, that compound interest line, that 5%, measly 5% compound interest line will go up faster and faster and faster every year. Therefore, the average rate of return making it more and more difficult for it to catch up or keep up. And then when another market correction occurs, as we know they all do, the average economic cycle, by the way, is 5 to 7 years. So it happens. We, of course, have gone through one of the longest economic cycles in history, certainly the longest bull market in the stock market in history. 10 years plus now. The bottom line is it will correct again, and now the compound interest just keeps going. So who's going to win the race? This is the turtle and the hare. Give it time, compound interest will outperform average rate of return as long as there's some correction in that average rate of return at some point through the process. So bottom line, a 5% compound interest outperforms 8% average rate of return if there's a loss of 20% or more in any of the given years, no matter when that loss occurs. And again, the question you have to ask yourself is this: what are the chances of a market correction or loss in the future? Looking forward to next segment where we're really going to cover how your personal bank works. You're listening to Your Personal Bank Show. Contact us at 866-515-6280 or yourpersonalbank.com.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're in the second half of the Your Personal Bank Show. And again, we've been covering a lot of great stuff. Looking forward to a lot of awesome stuff coming up. And we're previewing next week. We have an awesome guest. You want to tune in next Tuesday at noon because we have one of the most famous people as a guest that you've never heard of, John Burley. He's a best-selling author of Money Secrets of the Rich. And you're going to want to listen and hear what John has to share with us next week. We just covered the first couple segments here. We talked about cash flow destroyers, debt, taxes. We talked about the power of compound interest. And I want to get into how your personal bank really works. But before I do that, I've got to finish a couple thoughts up on the compound interest. Again, compound interest is one of the most powerful tools. It's been called the eighth wonder of the world by many people. It's a powerful concept. And again, the key to compound interest is understanding the difference of compound interest versus average rate of return. And we discussed in the last segment about the difference. Again, 5% compound interest outperforms an 8% average rate of return if there's 120% loss or larger in a decade or any time period, frankly, of that average rate of return. And if you understand compound interest fully, you understand compound interest increases at an increasing rate. Therefore, you have more and more money every year, and it keeps going up faster and faster. Now, why do I bring up compound interest so much? Well, I love one of my favorite quotes. One of Warren Buffett's most famous quotes is rule number 1, never lose money. Rule number 2, never forget rule number 1. You know, there's a pretty savvy guy about money, and he's right. Because, see, the compound interest destroyers, you know, there's two of them, really actually three key ones that kill compound interest. One is losses. So if you have an account that's growing over time, and then there's a market correction, a loss, whatever it may be, you know, you not only kill the compound interest, but you lose momentum. You backtrack. You lose from where you were gaining, and you have to go up from there. And again, that's understanding, again, the difference between average rate of return versus compound interest. You have to make up the lost ground. Now, what a lot of people don't realize is this. Again, it's math. Bottom line is this. If you lose 20%, for example, you can't make back 20% and be back to even. Let me use a quick example. If you have $100,000 in an account, for example, and you lose 20%, it goes to $80,000. Okay, the next year you make 20% back, you're not back up to 100. You're still underwater. You have to have the greater the loss, the greater the gain has to be to make up for that loss. So the more and more losses we have, or the bigger the loss is, the harder it is to overcome. So that's why it's such a powerful loss in terms of a compound interest destroyer. The second thing is, most of the cases, we work hard for the money we use to invest. It's hard-earned dollars. It's not just dollars you lost. It's actually blood, sweat, and tears, or time. In other words, how long, I use my example, you have a $100,000 account. How long did it take? What time frame did it take you to create the seed money for that account? Did you put a year in? Did you put in months, years even? My point is, if you have a loss, and let's say it's a year's sweat equity of your time, blood, sweat, and tears to create that cash to create that account in the first place, you didn't just lose the money, you lost the time. I'm a financial guy, and I talk about this all the time. Money's important, but the thing is, you can replace money. Can anybody replace time? Nobody's figured out how to do that one yet. So the bottom line is, you've lost more than you realize. Now, of course, when you lose time, you lose momentum and the compound factor. So that's your compound interest destroyer. So that's why it's so powerful, the power of compound interest, understanding it. And the last key point I'm going to share about this, and we'll really get into how your personal bank really works, is let me use an example. Let's say you're 50 years old today, and let's say your money compounds at 5%. Well, you realize your money in your lifetime, average life expectancy today will turn into $55,000. In other words, for the average 50-year-old, your money will increase five and a half fold. 10 grand would turn into 55 grand, for example. For a 30-year-old, it'll compound 14 times. So that same 10 grand will turn into 140,000. Why is this so important? People say you can't teach millennials anything these days, and I completely disagree. In fact, one of my favorite things to do is to meet with a millennial, which is usually the son or daughter of one of my clients, because mom or dad told them to talk to me. And what usually happens, they'll want to meet me at a coffee shop, and because they're nice folks and they love coffee. And the funny part is they usually will buy because, they were referred by mom and dad to meet this guy and talk to him. And I let them. And then I share them this little concept of the power of compound interest. And the fact that at 30 years old, 10 grand will compound 14 times in your lifetime. And most of them at that point will look at me, they'll look at the 2 cups of coffee, and I won't quote what they say, but it's, oh my gosh, I just spent $100. And I look at them and smile and say, bingo, you just got the point. In other words, apply this in your life to everything you spend money on. Whether it's a cup of coffee, a car, a house, or any other item you may purchase. I'm not saying don't buy coffee. What I'm saying is one of the wealth keys is the wealthy understand the true value of $1. When you trade that $1 for a cup of coffee, did it cost you $1 or something more than that? Obviously, the answer is more. Why? Because you just spent the money, and that money, you gave up the ability for that money to earn for you in the future. So again, I'm not saying don't buy coffee. What I'm saying is understand the true cost of that coffee. And if it's really worth it to you, and by the way, some mornings it is. I agree. It's worth it. But is it worth it every day? See, we get into these habits and things that change our financial picture and change our future. And a coffee a day, for example, particularly for a younger person, can be a powerful financial success secret in the future for them. Because, again, the power of compound interest. Again, I shared this chart I was trying to describe in the last segment of the power of compound interest versus average rate of return. If you want a copy of that chart, because it's hard to describe over the radio, contact us at 866-515-6280 or yourpersonalbank.com. We'll be happy to send that to you so you can see what that looks like. So to have compound interest work for you, see, here's the other big key. It has to be consistent, safe, ongoing, steady Eddie, if you will, on gains. You can't have significantly variable, and certainly you can't have losses. Also, if you withdraw or sell your asset, you take money from it, what happens? Compound interest works like this: 1 to 2, 2 to 4, 4 to 8, and so on. Let's say you're at the point where you went 1 to 2, 2 to 4. You've been compounding your money, and then you're approaching. You're going to go 4 to 8, and now you need the money, or you have an expense, or you're retiring. Well, what happens to your compound interest? It stops. You just took the money. So the key is you need to find a way to have your money continue to grow while you can access it for those things that we all need. You know, we all have expenses. We all have things we want and need in this world. And the reality is you want your money to keep working for you. And that's where, again, your personal bank really comes into play, because you can own an asset, you can own an account that will continue to grow. You can access funds while still allowing compound interest to grow for you. Now, again, if you want to understand how this works specifically, you're going to have to contact us. But what I want to talk about in the next segment we're going to be coming up is the most common investor mistakes, and there's about 5 of them. And again, this comes from various sources. I've referred already to the Dalbar study and a statistical research study that's been done for over 30 years. In the next segment, we're going to talk about the most common investor mistakes. So I'm recommend you tune in. But also, next week, we have an awesome guest coming up, John Burley, and you're going to not want to miss that. He's one of the most famous people you don't know, but you're going to learn some awesome stuff. Contact us, 866-515-6280 or yourpersonalbank.com, and we'll be right back with the most common investor mistakes.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. Segment 4, the Your Personal Bank Show. We've covered a lot of great stuff today. We've talked about the cash flow destroyers, debt, and taxes. We've talked about the power of compound interest. We've really spent some time on that because that one's just so important to understand. Understanding the power of compound interest over average rate of return. And in the second segment, I really just tried to describe a chart, if you will. It's a very simple chart. It's 3 pages. There's 3 separate charts. I'm happy to send that to you. But it really shows the difference of an average rate of return versus compound interest. And this is a very simple chart. It's mathematical. It's numbers. Where a 5% compound interest outperforms 8% average rate of return over a 10-year period, as long as there's a 20% loss somewhere in that 10-year period on the average rate of return. So in other words, you can have an average rate of return account, a market-related type of investment account with an 8% average rate of return. There was one, you made more than 9 of the 10 years. You lost 20% one of the years, versus a 5% CD, for example. And the 5% CD has more cash in it. And of course, if you understand compound interest increases at an increasing rate. So therefore, each year, it keeps going faster and faster, which causes the average rate of return to have more and more difficulty to keep up. So that's the power of compound interest. Now, the last thing is, people say, well, if I don't touch my money, it's compounding. Well, yes, and you can't have losses. Remember, it has to keep, like Warren Buffett says, rule number 1, never lose money, one of his most famous quotes. Rule number 2, never forget rule number 1. So you have to have those 2 factors in terms of you can't touch it, 1. 2, it can't have losses. Now, if you have an account like that, you're going to benefit from compound interest. And that's one of the things your personal bank does. Now, the thing is, if you're going to operate a bank, you got to think like a banker versus an investor. Now, what do I mean by that? And like I said, I've been teaching this concept for years. But as some of you know, the last year or so, I've been working on this project. I'm the chairman of the board of a community bank in formation. So I got a little bit of credibility in that area, learning how bankers think. And bankers are very risk adverse. In fact, I'm excited. We've got the president of the number 1 rated community bank in the United States coming on as a guest on one of our upcoming shows in a couple of weeks. So stay tuned. The bottom line is, what's the difference between how a banker operates and how a typical investor operates? Here's the difference. Most investors trade hard-earned dollars for assets with the expectation the asset will increase in value, and in most cases focus on potential gains only. They don't create much or any cash flow in many cases, and very rarely ask what's the recourse if things go wrong. I ask people all the time. They'll say, "Hey, I got this great investment, blah blah blah," and I'll ask one simple question: "Well, what happens if it doesn't work out?" And the answer is, that's not a good plan. And I always say this: look, if you can purchase a stock, a piece of real estate, or a business, can you tell me what it'll be worth in a year? And the answer is no. We can look at charts, we can guesstimate, but we just don't know. And this is not from me. This is from several various sources. Is investing primarily for appreciation is just another form of gambling. And the reality is this: if you can only make money if it goes up, well, what's the difference? They're right. So, how does a banker operate? As I always say, look, we've all taken mortgages or car loans, or most of us, at some point in our life. And when we signed those papers, we knew we'd have a payment. Did you plan to make the payments? Of course you did. You wouldn't sign the papers otherwise. And guess what? The banker knows that too, because you went through a whole approval process, ensuring that you would most likely make those payments. And in the chance that you did not make the payment, what happens to the house or the car? They take it, sell it to somebody else, creating payments from that person, therefore creating a cash flow. What did the banker do? Created a cash flow for themselves and had collateral, protection, downside protection. So my point is always, whenever you're looking at an investment, whatever that is, and really my role is not to tell you what to invest in. I tell people this all the time. If you have something that you really enjoy, that's your thing, my gosh, it's working, keep doing it. Okay? I know that's unusual advice, but the reality is, do it. The key is, though, what's your plan B? Do you have a plan B? Because market cycles happen. Don't be surprised when they do. So what's a personal bank? Well, it's really quite simple. You create an account where you have access to cash. There is protection, downside protection involved. You have earned interest on the funds, okay? And if you access the funds against the collateral, you can actually earn interest on those funds that you borrowed, and you can create tax-favored growth, tax-favored income, and supplement retirement. Now, understand, the contract has to be structured properly with specific riders, and you have to utilize policy loan provisions properly. And the tool we use most often is insurance. It's a very specific type of tool, high cash value tool. And a lot of people say, well, when I say insurance, they say, why? We could use any financial tool for the personal bank concept, okay? It's just the one from a process of elimination works the best. Compound interest. You want an increasing cash flow. You want more money every year. You don't want risk of loss. You don't want to borrow against an asset that can lose value. That's a recipe for disaster. You want liquidity. You want access to your funds day one, okay? Move forward and have more and more access to funds over time. You don't want to have an account where you have a lot of restrictions or penalties or tax penalties and such. Okay, so that kind of knocks the IRA 401k world off the table. The market type investments are off the table, and you want tax-favored growth, withdrawals, and tax-free to the heirs. If it's structured correctly and handle it correctly, of course. That's the key. Now, like I said, my biggest challenge, I say insurance, people say, gosh, I've got the home, the auto, last thing I need is another bill. They're thinking of insurance as an expense, not an asset, not a financial tool. They miss the point. Stop listening. Again, they miss the whole point. See, most insurance contracts are structured, and I had a person ask me this literally yesterday. Can I take my existing insurance contract and convert it over into a personal bank contract and grow cash? And I said, depending on the contract, the answer is yes, and we can do a tax-free 1035 exchange, it's called. It's IRS code 1035. And then they sent me a copy of the contract, and it was a term policy with no cash. How can you convert something that has no cash into something that can grow cash? Again, the purpose for insurance for most people in most of their minds, it's a protection tool only. or primarily. It might have a little cash, those kind of things. It's focused on protection, death benefit protection for your heirs. And your personal bank policies have death benefit protection also, but that's a secondary, that we maximize the cash and minimize the death benefit based on the rules, the tax rules and limits that are available. It's called the MEC, Modified Endowment Contract, which is also a tax rule. We maximize the cash, minimize the death benefit. That's the goal here. So when people ask me death benefit related questions or protection related questions, because they get hung up on that, I'll stop them a second and say, let me ask you a question. Are you trying to maximize death benefit or maximize cash? And invariably, they'll say, well, I want to maximize cash. And I'll say, then why are you asking me death benefit protection questions? If we want that tool, I can help you get that done. There's plenty of places to go for that. That's not what we're here to talk about. So the bottom line is we want to grow cash. We want to have access to that cash. We want to have control of that cash. We want to minimize debt. We want to take advantage of compound interest. And we want to have, again, the key success principle. And this kind of leads me up to guest we're going to have next week, John Burley. You're going to want to listen to this because he's got an event coming up in November here in Phoenix. If you haven't been to a John Burley event, I have. I can highly recommend it. If you want to learn how to run a real estate business, not be a real estate investor, I say this all the time. It's a business like any other business. And if you don't take the time and get the education and get the mentors, you're asking for trouble. But John is going to teach you how to not focus on the price of real estate, but focus on the returns. And the key is it's a business. And that's how you're going to become successful. So tune in next week, Tuesday at noon, at Money Radio, 1510 AM or 105.3 FM or moneyradio1510.com. Contact us at 866-515-6280 or yourpersonalbank.com if you have any questions or just want to chat and figure out how this could fit for you.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.